Imagine an economy where nobody borrows money. No credit cards. No loans. No mortgages. No buy now, pay later. Just cash. What you earn is what you spend. Sounds safe, clean, responsible. It would also collapse almost immediately. That's the uncomfortable truth most people never hear. Modern economic systems don't just allow credit. They quietly depend on it. And once you see why, a lot of things that feel broken suddenly make sense. Right now, debt levels are exploding. Household debt, corporate debt, government debt. At the same time, wages feel stuck. Prices feel heavier. And everyone keeps asking the same question. How is this still working? The answer is simple and unsettling. Because the system isn't designed to run on savings. It's designed to run on credit. Let's rewind. Picture a small town a few hundred years ago. No banks. No financial products. Just people, goods, and time. If you wanted to build a house, you needed years of saved labor. If you wanted to start a business, you waited. If the harvest failed, everyone felt it immediately. Growth was slow. Pain was honest. Limits were visible. Then credit entered quietly. Not as greed. Not as manipulation. But as a shortcut. Instead of waiting 10 years to build, you borrow from the future. Instead of saving for decades, you move time forward. Credit didn't just make things faster. It made them possible. Factories could be built before profits existed. Infrastructure could exist before taxes arrived. Companies could scale before they were profitable. Credit compressed time. And that's where the system changed forever. Because once growth depends on pulling future money into the present, stopping becomes dangerous. Here's the core idea most explanations miss. Economic systems don't prefer credit because it's risky. They prefer credit because it smooths reality. Without credit, spending rises and falls violently. Booms are short. Busts are brutal. With credit, pain gets delayed. Instead of a recession now, you get manageable payments over years. Instead of collapse, you get adjustment. Instead of failure, you get refinancing. Credit turns shocks into slow leaks. And governments, banks, and markets all quietly agree. Slow leaks are easier to manage than explosions. But there's a hidden mechanism underneath all of this. Most money you use isn't created by governments. It's created when credit is issued. When a bank gives a loan, it doesn't hand out existing money. It creates new money on the spot. Not printed. Typed. Loan approved. Money appears. Debt appears. 2 entries. 1 system. That means growth itself becomes tied to borrowing. No new loans? No new money. And that's where the pressure begins. Because once an economy grows on credit, it needs more credit just to stay stable. Think of it like a moving walkway at an airport. If you keep walking, everything feels normal. If you slow down, you fall behind. If you stop, you get knocked over. Credit keeps the walkway moving. House prices rise because mortgages expand. Stocks rise because leverage expands. Governments function because deficits expand. Everyone knows it's fragile. No one wants to be the one who stops it. Here's where the irony kicks in. We're told credit is about responsibility, about discipline, about trust. But system-wide, credit rewards the opposite behavior. The entity willing to borrow more grows faster. The company willing to leverage outcompetes conservative rivals. The government willing to run deficits avoids short-term pain. Meanwhile, restraint looks like failure. Saving too much slows demand. Paying down debt slows growth. Stopping borrowing looks like a recession. So the system gently nudges everyone in the same direction. Borrow now. Worry later. This is why paying off all debt would not fix the economy. It would break it. Because debt isn't just obligation. It's structure. It's future demand already spoken for. Remove it too fast and spending collapses. Jobs disappear. Tax revenue falls. Defaults rise. Which is why every crisis response looks the same. Lower interest rates. Extend maturities. Add liquidity. Never remove credit. Just make it easier to carry. And this is where the math gets uncomfortable. Debt grows exponentially. Income grows slowly. Over time, more effort goes into servicing the past, instead of building the future. At first, it's manageable. Then it's noticeable. Then it's political. You don't feel it as a number. You feel it as pressure. Rent that never feels affordable. Salaries that never catch up. Governments that feel broke despite massive economies. It's not mismanagement. It's arithmetic. Credit lets the system borrow stability from tomorrow. But tomorrow eventually arrives. And when it does, the choices get smaller. Raise rates and risk collapse. Lower rates and inflate assets. Print and debase. Austerity and destabilize. None are good. All are familiar. Zoom out and the picture becomes clearer. Economic systems prefer credit because it keeps the machine running quietly. It hides trade-offs. It delays accountability. It smooths the story. But it also concentrates power. Those closest to credit creation benefit first. Those furthest pay last. Asset owners gain. Wage earners wait. Future generations inherit obligations they never agreed to. Not through conspiracy. Through design. Credit isn't evil. It's useful. But it is never neutral. And every system built on it eventually faces the same question. How much of the future can you spend before the future pushes back? Because at some point, credit stops being a bridge and starts being a trap. The uncomfortable part isn't that the system prefers credit. It's that it may no longer know how to function without it. So the real question isn't whether debt is too high. It's whether an economy built on borrowing can ever choose to slow down without breaking itself. And no one seems eager to find out.